When it comes to investing, it's not just about what you make. It's about what you actually get to keep. And that's what we're talking about today. We're going to dive into how taxes can take a serious bite out of your returns, and more importantly, the smart strategies you can use to hang on to more of that hard-earned cash.
So let me just ask you this. Are taxes eating up your investment gains? I mean, it's a question every single investor has to face, right? You see that awesome growth in your portfolio, but when you go to cash out or collect that income, how much of it is really yours? The thing is that the federal government taxes dividends, interest, and capital gains. And if you don't have a plan, that can seriously shrink your bottom line.
43%. So what's that? Well, that's how much you could potentially save in taxes on a single dividend payment. And how do you do it? It all comes down to one really simple rule about how long you own a stock. That's it. That's the power of investing with taxes in mind. So let's break this whole thing down.
All right, first up, let's get into the money your investments generate while you own them. The regular stuff. Dividends from stocks, interest from bonds. The way you earn this income makes a huge difference in how it gets taxed.
Okay, so here's the big deal with dividends. There are two kinds, qualified and non-qualified. And trust me, you want the qualified kind. Why? Because they get a way lower tax rate, topping out at just 20%. The other kind, non-qualified, oof, those get taxed at your regular income tax rate, which, yeah, can be a lot higher. So what's the secret to getting that sweet, lower rate? It's all about the holding period. You just have to own the stock for a little over 60 days around a specific date. It's a simple rule, but man, does it have a massive impact.
Let's put some real dollars to this so you can see what I mean. Imagine you're in the 35% tax bracket and you get a $500 dividend. If it's non-qualified, bam, that'll cost you $175 in taxes. Look at that first bar. But if you just held on to it long enough to make it qualified, the tax bill drops all the way down to $100. That's a $75 savings, just like that. That's money that stays right in your pocket.
All right, what about interest? Well, the rule here is usually pretty simple. For most things, think corporate bonds or even just a high-yield savings account. The interest you make is just treated as ordinary income. That means it gets taxed at your regular rate. Simple enough. But there's a really big exception you need to know about. And here it is, tax-exempt bonds. You've probably heard of them as municipal bonds or munis. The interest you earn from these is, get this, usually exempt from federal income tax. And depending on where you live, you might not have to pay state and local taxes on it either. This makes them a super powerful tool, especially for folks in higher tax brackets who are trying to lower that tax bill.
Okay, so we've talked about the income you earn while you hold an investment. Now let's switch gears and talk about the profit you make when you actually sell it. This is what we call a capital gain. And believe me, when it comes to taxes on these, timing is everything. And just like with dividends, there are two different buckets this can fall into. If you sell something you've owned for a year or less, that's a short-term gain. And guess what? It gets taxed at your higher ordinary income rate. But if you just hold on to that same asset for more than a year, suddenly it becomes a long-term capital gain. And your reward for that patience is a much, much lower tax rate. We're talking 0%, 15%, or 20%. This really shows you just how much of a difference 1 year can make. Let's say you're in the 24% tax bracket and you've got a $3,000 gain. Sell it too soon, and you're looking at a $720 tax bill. That's the short-term hit. But if you just wait a little longer, make it a long-term gain, that tax bill drops to $450. That's a huge difference for just a bit of patience.
Okay, but let's be real. Not every investment is a winner, right? So what happens when one goes down? Well, nobody likes losing money, but here's the cool part. You can actually use those losses to your advantage. It's a strategy called tax loss harvesting, and it's a super proactive way to manage your taxes.
So how does it work? It's actually pretty simple. Step 1, you sell an investment that's down to lock in or realize that loss. Step 2, you use that loss to wipe out capital gains you might have from your winners. This shrinks your taxable profit. And here's a bonus. If your losses are bigger than your gains, you can use up to $3,000 of that net loss to lower your other taxable income, like your salary, every single year.
Now, before you get too excited and start selling all your losers planning to buy them right back, hold on. There's a catch. There's a critical IRS rule you have to know about, and it's specifically designed to stop people from, gaming the system.
It's called the wash sale rule. And here's the deal. If you sell something at a loss, you can't buy it back, or something substantially identical to it, within 30 days. That's 30 days before or after the sale.
If you do, the IRS says, nope, sorry, and they won't let you claim that tax loss. So you can't just sell for the tax break and then jump right back in. So take a look at this. It really spells out the danger zone you have to avoid. It's not just the 30 days after you sell. It's also the 30 days before you sell. When you add it all up, it creates this 61-day blackout period where you have to stay away from that security if you want your tax loss to count.
Whew. Okay. We have covered a ton of ground, haven't we? From dividends and interest all the way to gains and, yes, losses. So let's pull all these threads together into a simple strategic plan that you can actually use.
All right, here it is, your tax smart checklist. Pretty straightforward. First, with your winners, be patient. Try to hold them for over a year to lock in those sweet long-term gains rates. Same goes for dividends. Make sure you're holding them long enough to get that qualified status. Now for your losers, don't just sit on them, put them to work. Use tax loss harvesting to cancel out your gains. But always, always keep that 61-day wash sale window in mind. And last but not least, when you're thinking about bonds, maybe give those tax-exempt municipal bonds a look to get some tax-free interest.
So all of this leaves us with one final, really important question to ask yourself. It's one thing to have a portfolio that looks great on paper, right? But is your portfolio structured for profit or for after-tax profit? Because at the end of the day, thinking about taxes isn't something you do once a year. It's a core part of building a truly successful long-term investment strategy.